Welcome to TheoTrade. This is Don Kaufman. Here we are. It's February 21st, 2018. We've got just about 15 minutes left in the trading session. You know, if you just turned on the screen right now, you'd think to yourself, hey, let's go take a look at those S&P futures. It looks like a fairly docile day. It's been anything but a docile day. All right. What really kicked off some of the volatility this morning? So throughout the course of the morning, the S&Ps rallied up, and quite substantially so. So the S&Ps at one point were up over 30 points. Now, right in this neighborhood, and I'm actually going to mark it on your screen, right in the neighborhood there, when the S&Ps were trading just shy of 27.35, right here is exactly where the FOMC minutes came out. After the FOMC minutes, market exploded higher, literally another 12 points higher, only to then turn around and fall. Okay, well, we're still falling right now, again, with just about 15 minutes left in the trading session. This can only be described as what I would term the bond bath. The bonds sold off just after those FOMC minutes and have continued to feel pressure. Now, not everybody necessarily looks at the bond market and what the impact of this can ultimately be. So let's move away from the ZB here a minute, which happens to be the 30-year bonds, and let's take a look at the TNX, okay? And this is the TNX on an intraday basis. And again, I want to describe, because not everybody has looked at the TNX before, it's the 10-year Treasury Index. Again, the 10-year Treasury Index. And you can see just at the time that the FOMC minutes came out, it was sitting, it looks like what it says, 29. Well, it does say 29, but in fact, this is indicative, okay, of a 2.9%, okay, interest associated with 10-year notes. All right. Ultimately, what occurs? Well, the FOMC minutes come out, this thing takes off to the upside, and we bumped up again a monstrous amount. We're getting dangerously close right now to what we would term 3% territory. And the impact upon the equity markets, many believe would be extreme if the 10-year starts to appreciate beyond 3%. So again, what we're getting here is interest rate fears, and rising interest rate fears, they're all resurfacing in today's marketplace. Now, we haven't hit what I would think is that big threshold for pain, which is probably right around 3%. And that's going to, catch everybody's attention in the entire, trading world, the entire investment world. I think everybody has to stand back and look at what a 3% interest rate and associated with that 3% interest rate, what the impacts can be. And this is something that, I've mentioned time again here on TheoTrade, but everything from stock buybacks, okay, dividend payments. I mean, we could go on for a half an hour of about where that 3% interest rate could technically impact and really be very prohibitive. Now, let's move a little bit further past what I kind of call the bond bloodbath, if you will, or the bond bath, with the bonds selling off. I wouldn't be surprised that in the next 24 hours to see the bonds and the notes sell off a little bit more and actually clip into that 3% range. Again, the momentum is headed that way in a rising interest rate environment. Okay, so time out for just a second. I want to go back for a moment over to intraday trade, because one of the things that I've been stating incessantly on some of these evening videos and the weekend update is that volatility and fear is still very much prevalent in the marketplace. And I want to describe that because, moving forward, I know a lot of people want me to come on here and throw out like 20 different trades. Right now, you do, for the time being, still have to be thinking quite defensively. Listen, most retail clientele, whether you're an investor or whether you're a trader, haven't experienced any heavy amounts of volatility. So for the most part, the single most important aspect that you could really pick up in a video like this is risk mitigation first. Understand your risk, recognize that markets right now can move wild amounts in incredibly short periods of time, and that we actually believe that we're only seeing, if you will, the surface of what could be an explosive volatility situation. And again, we're just scraping the surface of the volatility inside the markets. But the S&P futures, and here's just a prime example, these things reek, all right, of lack of liquidity. I mean, you're seeing, again, movement. And again, let's just zoom in here because this is going on while we're actually kind of, shooting this video here. This is a move that just took place moments ago. That's over a 6-point range in a 1-minute candle on the S&P futures. And again, that reeks of lack of liquidity. It reeks ultimately of algorithms running amok over here. We're clearing over 10,000 contracts. And if you've never traded in a situation like this, people, it's starting to get more extreme out there. Now, to kind of move further and to show you evidence of this, I'll go back to the volatility futures, and I talked about this a little bit on the weekend update, and I'm going to talk about it again. Never trust a marketplace for even a second on an intraday basis when the volatility futures themselves are inverted. And we most definitely have inverted volatility futures. Look, we have 28-day vol futures that are above the 56-day volatility futures, which are above the 84-day volatility futures. So the curve looks something like this, where again, the risk, okay, is here. The risk is now. And they're actually saying risk is likely to abate in the future, which is an insane piece of kind of logic that you have to kind of grip hold. And again, I know people are they're gonna see the market close and like, oh, the S&Ps, they're only down a few points over here. Again, all the hallmarks of wild volatility are effectively here. Now, there's another aspect that I've been picking up on in some recent trading sessions, and I want to go into a little bit more depth about that. We're going to zoom out for a moment. It's not often I talk about this, but we're going to look a bit at the dollar. Now, 2 weeks ago is when we saw some of the most wild volatility in the market. Take a look at the dollar exploding back to the upside as the S&Ps were getting hit hard ultimately to the downside. Well, last week the dollar sank and the S&Ps once again, what did they do? Well, the S&Ps at that point took back off to the upside. We'll take a look again because the dollar is exploding back. And again, there's been a long time since there's been this inverted relationship, okay, between the S&P futures and the dollar. I think you need to pay very close attention to the dollar along with the bonds in intraday trades specifically here, but also be mindful, again, on a day-to-day basis, the dollar rallying appears, okay, to have a negative impact on the broader market. And again, you can see right after the FOMC minutes, the dollar sold off only to explode back to the upside. And here we are with 3 days that are having a fairly wild range to the upside inside of the dollar. All right, so moving forward, and one of the most important things is just that, moving forward, what can we expect? First of all, I would expect considerable more volatility in the remainder of this shortened week. To quantify that, and again, that's one of the most important things, to say, well, it's going to be considerable volatility, what does that really mean? Well, get a little bit of an orientation of where we are on the week. So the week started, we had about a $53 expected move, and you can see again the range today being fairly substantial. The S&Ps though are still extraordinarily close to where they started the week. Okay, I believe again that the bonds are going to continue to sell off here. Even if it's mildly, it's still going to threaten that 3% range, and we're likely to see sell side activity permeate back into the S&Ps. Okay, for a low of the week, this is a week where, hey, let's say that we stay inside the expected move. We should be right around 2680. Again, 2680 on the SPX, and that's not like catastrophic sell side activity. That it would be kind of the first target to the downside. That is the edge of the expected move. But the expected move, you have to remember, in most of the recent weeks, has been getting smoked. Again, a sign of a marketplace that is extraordinarily inefficient and a marketplace that is doing wild things. Again, the first target to the downside would be right around that 2680 marker, which, again, in perspective, is only about 30 points lower. Okay, now, what else would I actually expect this week? Let's go over to the XLF momentarily. The XLF, if you take a look at the option chain in the XLF, the volatility is up around 21%. Still got a 42-cent move packed in. The XLF, okay, I believe has pretty much the largest risk of any of the major, okay, sectors inside of the S&P 500. It is a sector that has rebounded substantially along with tech. Okay. Nevertheless, I believe that the most interest rate sensitive of all of the sectors would undoubtedly have to be the XLF. And again, last but not least, as I was actually mentioning a bit about risk in the SPX and talking about a $53 expected move, be, again, very aware that the expected move for the remainder of the week is still sitting right at about $32, which, again, it corresponds to the movement right to the edge of, again, as we said, just in that neighborhood on the S&Ps of about 2680. That would be the target to the downside. And again, most of this sparked from those fears of interest rates kind of resurfacing. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.